Rhythm, historically when Fed has moved, the previous moves have been very synchronized with other central banks. This time it could be different. ECB is following a different policy regime. Reserve Bank of India is likely to follow a very different regime. So how do you map the world? Because there is a lot of confusion, there is a lot of chaos, and there is no parity in central bank policy action.
No, so the point on RBI, I think, is the most important one, which is that the first time we've decided to move against the Fed. So we hadn't done that since we opened our capital account to foreign flows.
It's never happened.
No, in the early 90s. So this is the first time we've chosen, and we did it before the Fed. So I think it was known that the Fed is going to hike at some point in time, if not December, then March. So the fact that we moved, I think, underpins our macro stability, which is the central bank is quite confident that we are able to handle this, which is so different from 2013, when the taper tantrum caused havoc in our currency markets and our equity markets and caused a lot of outflows. So we're not in that situation at all, and I think that's also evident in the way India has been differentiated in the emerging market basket. Both in terms of how we trade on relative valuations as well as how we have performed, generally speaking, since 2013. So I think India is looking different from the Fed. The rest of the world, I'm not so sure, Nikunj. We'll see in 2016. But there is a case, albeit small right now, as it seems, but there is a case for the other two developed market central banks to also move at some point in time. As their growth data improves. So I don't think we should just base it on the current observation that the euro is easing a bit and Japan has still not got his foot off the pedal and the Fed is hiking. We'll see in the next few months whether that changes or not. I would actually say that the euro did not ease as much as markets were expecting. Yeah. So to some extent there is a little bit of a delta there actually in the same direction as the Fed. So it looks like that the developed world has better grip on growth versus the EM world. I think the problem is actually in the emerging market world, especially in China, which I think is still facing a lot of excess capacity and is exporting deflation, and some other emerging markets as well, like Brazil and arguably Russia, which are yet to do the type of structural reform or cyclical reform that India has done in the last 2 years. So I think India looks a bit different from the pack. The other emerging markets have a bit of problem, and developed world, I think, is a debate for next year.
Things started to worsen, if I can use that term relatively, in the last 3 or 4 odd months in terms of outflows, in terms of currency depreciation, in terms of even the reform process just slowing down a bit because of other factors. I mean, they've done outside the parliament whatever they can do. So my question to you broadly is, can the trend of what we've seen in the last 3 months in terms of FI outflows, in terms of currency, in terms of other factors, improve in 2016, and what could lead to that?
No, so that in
because
part,
inflation also seems to be just kind of rearing. I don't think we'll meet the Jan 2016 RBI comfort zone this time around.
No, we are inside the comfort zone.
But don't you think that the second half could be a bit worse because of weather conditions and CPI?
No, our view is that inflation is sub 5 by March next year. So our forecast is 4.7. Okay. So we're running into a little bit of a base effect that will again wane. So I don't think that's a problem for India. I think, forecast aside, let's look at the framework. The fiscal deficit is at a 12-month rolling fiscal deficit at 3.3. Okay, so the government is still very tight with spending. Right. Real rates are still positive. And there doesn't seem to be any impending commodity price shock coming from the rest of the world. Right. So we're not going to import inflation, and we're unlikely to see our own inflation because we've got very tight fiscal and relatively okay monetary policy. So I don't think there are inflation pressures in around the corner. But going back to your point on what we saw in the last 3 months, I think in part it reflects what the EM world has done, which is that we've seen some sort of capitulation. Okay, and the EM index has fallen a lot. So India has participated in that. In part, it has reflected some domestic factors. The market got nervous about the Bihar elections and sold off. And I think that nervousness was not well founded because we've seen that the government is still pushing forward reform. What's the nervousness about losing elections? That the government retracts its reform agenda and becomes more populist. I don't think that's the mood of this government. Yeah. In fact, it's actually the opposite. It's actually to push even forward. It's unfortunate that the parliament is not functioning because I think then the GST bill would have been done. So now I guess it will be done in the budget session or thereabouts, and therefore there is a delay. which is unfortunate. But I think otherwise, I think we're getting good execution from the government on infrastructure. Infrastructure spending is up about 25% this year. We're getting good execution on the fiscal side. They have tightly controlled it. They're not letting loose on that. And we're getting other non-legislative or what you'd call as executive reforms, like in the power sector. We've seen in the railways. So I think things are going pretty okay in India. Relative to the world, significantly better.
Yeah, but how does all of that translate into earnings growth, and when does that start to show up in a meaningful manner? It hasn't yet so far. And your earlier point on correlating the rates in India to the US, yes, we've cut rates in anticipation of this rate hike, but the path ahead for the Indian Central Bank is also one of pause. That's the expectation largely. I don't know whether you differ on that. And if that's the case, upside risks to inflation remain, then what's the way forward?
So we think another 1 to 2 rate cuts before March.
Okay.
Before March?
Yeah. So
2016, right?
Yeah. So you see, Nikunj, at the start of the year, Chetan was saying 125 to 150 basis points rate cut. Most people thought he was bonkers. We've got 125 this year. Okay. So I think I'd go by.
Also, to just be on the cautious side, because the opportunity window was only before the Fed hiked. Now that they have hiked, and if they most people are saying that they're sounding dovish, but I think some of the statements suggest that they're cautiously hawkish. So if they go ahead with one rate hike every quarter, then doesn't that, put the Indian Central Bank in a bit?
Lots of questions there for me to handle. So that wasn't the debate in January.
Okay.
In January, the debate about India was we have not nailed inflation and that inflation will remain persistently high. Our forecast was 4.7% for March and it remained that way. So we thought that rates had to decline by 125 to 150 basis points. We're not changing that forecast. So based on that, we still have another 25 at least, or if things are okay, then maybe even 50 to go before March. So there is 1 to 2 that is yet to come. Regarding your view on the Fed, yes, of course, the dots suggest that there are 4 rate hikes coming, but I think you need to take that in the context of the Yellen language. Our forecast again is the next rate hike is June. So they're not going to do a March. And again, my US economists called this way back in early spring that it will be December and not September and not March. So she has also been quite accurate about it.
I like the title of the report, Goodbye Zero Interest Rate Regime, Hello to Gradual.
Yeah, gradual. And gradual I think is unlikely to be 4 rate hikes in the next 1 year, even though that's what the dots suggest. Actually, the initial impression of the dots was that it was a hawkish, but if you look at the dots more carefully, they're actually quite dovish. The median number has fallen by about 20 basis points. And we're close, I think we're dealing with long range 3.25 forecast. And then there is this big caveat on inflation. So unlikely that the Fed hikes again in the next 6 months.
I don't follow dots, nor do our viewers. What our viewers follow is, if they want to follow is that what is your outlook for 2016? Do you think risk will come back? If risk will come back, will India underperform or will India outperform? Because if risk will come back, maybe Brazil and Russia will outperform more than India.
But your viewers are not concerned with India's outperformance. Because if I tell them that India has done well this year, it doesn't matter, right? The Nifty is down 8%. Right? So I think your viewers are...
relative grading.
Yeah, your viewers are concerned with India's absolute performance. And if risk comes back, India will do well on an absolute basis, albeit underperform the rest of the world. But I don't think that will matter.
Because the Nifty will be up. For the Nifty?
Sorry?
Will 2016 be a good year for the Nifty? Can we get double-digit returns?
I think that's our base case, that we get double-digit return. The caveat, of course, is that the world equity markets look a bit boring. And I think except for what looks like a nice year-end rally, because positioning was pretty weak across the world, we may still be challenged for absolute returns in the rest of the world in 2016. I think India will do its own thing like it has done in 2015. Mid-cap index will finish the year at about 6-7%. So I think India is still in a bull market. The way I judge this is that the breadth in this the market is still strong. And that is not like a bear market. In a bear market, breadth gets destroyed. In a bull market, yes, of course, the large cap stocks are pausing and waiting for earnings, and I'll come back to that question.
Yeah, just about to raise it again.
But the mid-cap stocks, wherever we've seen earnings, and there are quite a few places where we've seen earnings, have actually continued their run. So it is indicative of a pause in a bull market rather than the end of the bull market. So I think there's reason to believe we continue that in 2016, which is the returns actually turn. Also, it's very rare for India to do 2 back-to-back negative years.
Sure. Okay.
In the last 30 years, that's not happened. too often. So arguably, therefore, I think we should be looking at a positive year next year.
Ridham, so you were wanting to get back to that point about earnings as well.
Yeah, so we started the year with an optimistic view on earnings for the second half, and clearly the quarter in September has not panned out the way we would have thought it should have. There have been pressures from the world. I think the fact that PPIs and deflation has been a big problem for earnings. We think that these factors have hit their bottom, so things are likely to turn. Even in this latest quarter, if you strip out the global names, what the metal and mining companies did, what the SOE banks did, which have got a lot of earnings hinged to metal and minings, what Tata Motors did, I think the domestic earnings actually were close to double digit. So domestic earnings are actually turning, but there's pressure coming from the global names. I think this quarter will be actually better than the last quarter, so we should see that continuing improvement. And we remain optimistic for 2016 earnings. So I'm looking at double-digit growth into the next 12 months.
My challenge with a bullish assumption is that A, there are problems in the banking sector. B, corporate side of the country does not have a very strong balance sheet. So for the earning revival to really start, you need some participation. And from where will that participation come?
So Nikunj, so there are 4 drivers here, right? So I completely agree with you on private corporate capex. We in fact just finished a survey of India's top 200 companies, and they don't look like they're about to start a new capex cycle. They're guiding towards pretty weak capex numbers for the next, not just 1 year, but the next 3 years. And that proprietary capex survey of ours has predicted capex pretty well over the last 5 years. So it seems like they're still anchored to the situation of the last 3 or 4 years. That is one driver, right? The other driver is government capex, which actually I think looks quite strong going into the next 12 months, like it has been over the past few months. And I think that will probably be the bigger driver. In fact, I would go to the extent of saying that it's likely to be the driver for the capex cycle over the next 5 years, not just the 1 year. So if you go back to the previous cycle, two-thirds of capex in India was private corporate and 1/3 was government. I won't be surprised in the next 5 years it's the opposite, which is government is 2/3 and private is 1/3. So we have to stop looking for signals from private corporate capex because that's unlikely to be the leading driver. Second driver is consumption. So I think urban is already picking up, and I think my view is that rural has troughed. So rural should be a lot stronger, and that I think will be the big driver for the economy in the next 12 to 24 months. The third anchor is exports. And well, global trade has surprised all of us in the manner in which it collapsed in 2015. And hopefully that has put a bottom there. There is still drag from exports, and I'm not too sure about where that goes. But if the Fed's rate hike is any signal about their confidence on US growth recovery, then that's good news. It's good news for Indian exporters, particularly the IT services firms. When the Fed starts raising rates, IT services firms actually tend to do well. So I would be actually bullish on technology going into this rate cycle of the US. Albeit it's different from the past, because in the past when the Fed has hiked rates, there have been very rapid increases, whereas this one suggests to be, I think, a bit different.
Cycle.
But keeping that aside, I think if exports have troughed, then I think it should signal better economic conditions in India, because at least government capex and consumption will support growth.
Okay. What about the global liquidity environment? And again, this is from the point that you made earlier. So the Fed is going to lead the world back into the tightening cycle. The ECB is going to follow, perhaps Bank of Japan as well. If that's the mode, that means there's going to be a gradual withdrawal of global liquidity in that sense coming in from QE. Then what happens to the flows coming into emerging markets and countries like India, which have benefited from excessive FI flows?
No, I think that's a very good question. Very few people actually focus on this. So we have a liquidity proxy in there, which we do, and that peaked a few months ago. So we've been in a declining liquidity environment now almost 12 months. And obviously it coincides with the tapering of QE, and also the fact that Japan is not easing as aggressively as it was last year. And in effect that reflects why emerging markets have done so poorly. So the $50 billion of outflow that we've seen from EM in part reflects this liquidity squeeze that is happening. We have one thesis for 2016 or beyond, which is we title as triple tantrum, which is when if all the 3 developed market central banks start tightening, it will actually bring more pain to emerging markets. But I go back to the start of our conversation, which is I think India is getting differentiated. So it will not be treated as a basket case. I think a lot of the other EMs are facing a double whammy of liquidity withdrawal and falling commodity prices. To the extent that we are actually importers of commodities, it's being offset for India. So our BOP remains in surplus, and if anything, actually, the rupee is a tad overvalued, not undervalued, which is so different from the rest of the emerging world, which is facing a lot more currency pressure than we are. So we have our idiosyncratic macro stability factors, which I think protects us from this liquidity withdrawal. But I think this liquidity withdrawal is already happening, and we're on our way. Actually, it's not something which is new.
Let's take pointer from your initial answer, which is that Indian markets are trading at a premium. What has worked in the past is growth at any price, because globally and locally growth has been very precious. 2016 may be a better year, but it not be a very powerful year for global growth and for individual companies. So do you think the style which has worked in last 2-3 years, growth at any price, is that style here to stay?
No, I think it's changing already.
Yeah.
I think the market is becoming a bit more sensitive about the price that it's paying, which is why we've seen a lot of large cap quality names suffer this year. The market wants to get a bit more reasonable and a bit more, I would say, adventurous about what it wants to do with growth. So it's not just going to buy what has delivered in the last 5 years. It's looking prospectively and hunting for names which will deliver growth in the next 3-4 years and may actually be more reasonably priced. So I think the market is already changing character.
So actually, I want to scratch that point a bit further. The AMCs, the Indian fund managers that we speak to, are now not necessarily hung up on buying above a particular market cap. Their conversations seem to suggest that they are veering more towards where earnings could come in, as long as there is reasonable liquidity and as long as they are not micro caps in which they can get trapped if things change. So to your mind, if I was looking at a report that you will write or have written for 2016, what would be top of the focus list?
No, so this is the other feature that we've been discussing. We've discussed it on this channel before, that we are in a liquidity super cycle for India, which is domestic liquidity into stocks, in my view, will continue to get better as you go forward.
Right.
We've seen the market actually clear a fair bit of hiccup this year, and domestic flows have been quite resilient.
Yes.
So this lends more confidence to domestic fund managers to go down the cap curve.
Right.
Okay, because they know that there is liquidity that's waiting to come in, so they can tolerate the volatility that usually gets associated with mid-cap stocks. So I think this may actually continue over the next 3-4 years, and you may see more flows being attracted by growth-oriented mid-cap names, which actually ties into the point I made earlier, that there is growth available at a more reasonable price outside the large cap space where growth was getting very expensive.
Right.
On our focus list, actually, we are pursuing a few themes. So we think the dollar is likely to be strong. So it's a global call. In fact, we also think the yen is going to strengthen. And therefore, you want to buy stocks or companies that are hinged to the dollar. As I mentioned earlier, we think consumption will be a strong driver. So both rural and urban should do well. So we're buying rural and urban consumption stocks. And then you can decide whether you want to be on the top of the cap curve or bottom. I'm actually cap agnostic. So
you are, okay.
Yeah, so that in my focus list, I have a mix of mid caps and large caps. So I'm buying stuff which I think is priced reasonably for future growth. Then the third theme, I think GST will happen at some point in time in the next 3-4 months. So I think that will become a theme in the market. It has been a theme for a while, but I think it will probably gain momentum again. So that's the other thing that we're buying. We're looking at infrastructure as a big driver, as I mentioned earlier. So I think companies that benefit from higher infrastructure spending, which includes construction, capital goods, the guys who build infrastructure, I think those will be interesting places to be invested in.
Last Diwali when we were speaking to Ridham and we were talking about the lack of headline reforms, he said that his list runs into 10 pages, or was it 9.5?
Yeah.
So I don't know what's the list expanded
about
to.
15-16 pages.
16.
Yeah, we've seen the granular changes in the country are phenomenal. We've not seen those granular changes in a long time.
I agree.
We all focus on the headline thing, but underneath that there's a lot that has happened.
No. So I completely agree. I mean, simple things like the sugar cess, to my mind, I don't know, it's not a very well covered sector, but I think it does a long-term good for the space. But my question was essentially that amongst the non-headline reforms that are being taken, some are large, some are small, What has stood out for you? Because a lot of people believe that what's happening with the discoms is probably a bigger impact than what the GST could also have in the near term.
I agree. I agree. We've actually closed out. So we were underweight power utilities for 7 years. We closed that position out last month.
Wow, okay.
So we're no longer underweight. I'm not yet overweight, but I'm not underweight now. But I think the worst is over for them. So it is a tribute to the policy change that we are seeing. Now there are risks on the horizon, so let's not assume it's all done. But the fact that there is an effort to change things, I think will be good for the sector. And also the companies that actually build stuff in that sector, I think will do well.
And aligning with GST, you're essentially keeping your conviction call with logistics, the direct benefits.
Yeah, so there are all these host of companies that benefit because GST comes in. But the general theme is that larger companies, I think, in fragmented sectors will do well. Because today there is a fair bit of duty evasion that happens in the fragmented sectors where smaller companies get away by not paying taxes. And that comes at the expense of larger companies. They will have now a level playing field. So that I think will be the bigger thing. Logistics, of course, will follow.
Everything put together, fast, high frequency data is indicating that economy is healing, whether it is oil consumption or credit card spend or what is happening at ground level when it comes to, auction of natural resources. So there's a long list. Yours is a 15-page list. Mine is a 10-pointer list. It's not such a long list. I still focus on headlines. But if I look at the market behavior, L&T at a 52-week low. ICICI Bank at a 52-week low, BHEL at a 52-week low. Banks are not looking all that strong. So the market behavior is not aligning with what the mood and the data is indicating.
So I think, Nikunj, that is also to do with where the valuations were at the start of the year. So I don't think there's anybody out there who will say that Indian stocks are cheap. And the problem with expensive stocks is that, when they go through periods of growth stagnation, they tend to actually stagnate or go down.
Yeah.
So I think that could be one thing. The second thing is there are idiosyncratic reasons with all the companies that you mentioned. There are others that I could cite to you which have actually done quite okay. So there has been dispersion in performance, which also is because there is dispersion in growth.
Yes,
when that growth actually levels off and when it becomes more synchronous, you will see these contract actually. And in fact, this microcosm in India is actually also what's visible in the EM world. So yes. India stands at one end and the rest of the EM stands at the other end. And it's exactly how stocks inside India are behaving, which is you have a bunch of stocks which are at the EM end and a bunch of stocks which are at the India end.
It's so true. Okay. So in 2014, what we saw was hope and hype. New administration in place, markets, they run up, P expanded, earnings never expanded. Earnings have not come back. That has led to some disappointment. Do you think this time around markets will wait for earnings to come out and then the price action will happen, because once bitten, twice shy? And markets have not got the earnings cycle right.
I think the markets generally tend to be forward-looking.
Okay. So the move will happen before earnings.
They probably will, but
and you should buy before earnings recovery if you want to make money, right?
No, but of course there's skepticism. Okay. So there is skepticism, and it's not only to do with India; it's also to do with the way the world is. Let's put this into context. For 30 years, we've been in a bull market in the US. The world is now facing 3 problems. It's aging, it's got a lot of debt, and it's got deflationary pressures. It's not necessarily the best environment for equities, and which is why I think equity returns are actually tailing off. What I would say is that people cite the 30-year CAGR on the Sensex at 15 or 17% as the benchmark for the next 20 years. I think that needs to be debated a bit more. It is not necessary that Indian stocks CAGR at that rate, because global stocks may not actually deliver those type of returns, and nominal returns may be lower. They may still generate the same real returns that you got in the last 30 years, but nominal returns may actually be lower. We don't know. I mean, it's too long range of forecast for me to get into, but I wouldn't take a 17% number at face value.
In 2003 and 2008, we saw synchronized bull market, starting from gold to real estate to just about every major commodity. This time, that's not different.
That's not the case.
And that makes me more stronger about equities.
Actually, we will still end the year with equities as the best performing asset class.
It will actually. It will. So I asked the first question. Let the lady take the last question.
No, I was just thinking, interestingly, it's been 8 years, perhaps 9 years since the crisis, and we're still pegging investors. I don't know, you would be speaking to a lot of the institutional guys, but one is still pegging the benchmarks on interest rates to what they were, benchmark on returns to what they were in the bull market. And I think that's where the discrepancy lies in expectations versus where the what the real returns are looking like in this sort of low growth environment.
Yeah, but I can assure you, when I do my work at the bottom up stock level, there are lots of stocks in India that will do 15 to 20%.
Okay. So for the retail investors, there's hope.
There's always
a lot of money to be made in India. I remain very bullish with a 3 to 5 year view. Actually, I'm
at
hyper
the index
bullish.
level, given that we're coming from a weaker base in 2015, what is the expectation on the index?
So for the index, we're thinking about 20% as our base case for this year.
Oh.
So, and that's a pretty strong number in the context of the mid-single digits that we're expecting on average for the world. So India will do quite well relative to the world, I think. But if you take a 3 to 5 year view, I think you want to be in equities. You want to give a greater than fair allocation to equities, because that's where I think money will be made. The gold looks much more challenged. Deposits will probably give you single digit returns. So I think equities will still deliver better returns.
On that note, Ridham, thank you so much for taking the time out and joining us today and giving us those thoughts.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.